The recovery that we saw the first half of this year has continued to gain traction, starting to feed through a bit more into sales, not just prices rising, and prospects still look fairly positive. The main driver is the resurgence in population growth, and it's still very clear. You know, the outperformers are the markets that have seen the biggest turnaround in population. Around the interest rate outlook, with the RBA now clearly on hold, that removes a stumbling block for this upturn. We think it'll be sustained through the back end of this year. But we are going to see some more headwinds emerge. Near term, the return of sellers looks likely to be something of a headwind to momentum. Listings over the last 12 weeks have risen about 20-25%, heading into the over and above the usual spring surge. But beyond that, it's the return of quite severe affordability constraints that will be the main issue for markets. So price gains are looking pretty well assured through to the end of the year and into next year, but the pace is likely to moderate as affordability becomes more stretched. Well, as always, you know, there's a lot of variation around that national picture, market to market, and the exposure to those key drivers differs. You know, where we're seeing a big resurgence in population growth, those markets are getting more support. Where affordability is more stretched, they're likely to see more of those factors bite into the back end of this year and into next year, and also the supply-demand balance does differ market to market. If we start with Sydney, you know, that's where this population turnaround has been the starkest, and when the rebound of prices over the first half of this year has been strongest, also coming out of a deeper hole. But with the Sydney market, you know, we're heading into pretty diabolical territory as far as affordability goes, and by the end of this year the market's looking like it'll be very stretched, and we'll start to see some of those spillovers, demand softening, household formation rates changing, and probably some spillovers in terms of internal migration to more affordable markets. If we turn now to Melbourne, the turnaround there in population growth has been quite strong, but the market has been much more sluggish than other major capital city markets. That's partly because the Victorian economy was hit harder by COVID and is seeing a slower recovery. There's more of a hangover from those disruptions, but also there was some overhang of stock. So vacancy rates in Melbourne's rental market have been more uneven, have been slower to tighten than in other markets, but they're clearly tight now. Into the end of this year and next year, the Melbourne market is also likely to see the return of quite severe affordability problems that will hamper growth. So it's looking like an underperformer through this cycle. If we look at Brisbane, again, we're seeing quite significant lifts around the population story, and traditionally, Queensland is the state that picks up sort of spillover demand of affordability. Refugees from the major capital cities tend to gravitate north. That flow mightn't be such a big deal though, because the Brisbane market's coming to into this current cycle very stretched in terms of prices. Saw a very big run up in prices even prior to COVID, and then through the COVID resurgence, it's had a much milder correction since then. The tension there is we've got quite acute affordability strains, but also very low levels of rental vacancy, so a very tight market in terms of the physical supply-demand balance. So it should perform reasonably well, probably in the middle of the pack, maybe a little bit better. The outperformer over the next cycle is very likely to be Perth. In this instance, we've got a stronger economic backdrop in terms of the state's mining sector driving strong growth with some support from state government policies. And when we look at the housing market, it's been a long time between booms for the Perth housing market. It's coming into this upturn very tight in terms of supply capacity, very low rental vacancy rates. It's less exposed to these population dynamics, including the spillover demand from the major eastern states. But its market is so tight already, and it's got a lot more upside in terms of affordability headroom in the current upturn. So we see Perth as a bit of an outperformer. The smaller states look likely to be the laggards through the current upswing. In the case of South Australia and Tasmania, both have been largely bypassed by the population resurgence. There may be some spillover demand, but both are actually still contending with quite stretched affordability, particularly for local buyers. So both markets look sort of less positive in terms of their price prospects, although we still expect them to post decent gains, maybe a little behind the national performance. So it is a very varied picture city to city. The upturn's fairly general, and we'll see prices become stretched in most markets over the next couple of years. How that sort of spills over into shifts in population flows and so on will be quite critical to how the markets perform. And of course within each market we'll have this also the houses versus apartments split, which we may see some shifts relating to affordability as well. So overall, reasonably sound prospects for growth, but a very challenging environment in terms of affordability, and it looks like being a common theme in most submarkets. Well, firstly, with rental markets, what we can say is there's no signs of the pressures letting up anytime soon. Rental vacancy rates are very tight across the board. Rents continue to surge. And when we look at some of the supply drivers in terms of the provision of new rental supply, they look likely to be very slow to work through. If we look at rental yields for prospective investors, for example, they're still below the cost of funds for most borrowers and only roughly comparable to other asset returns. So when we look at shares or return on deposits, it's not particularly attractive at this stage. So even though we've seen this surge in rents, it's probably not enough yet to really draw investors back into the market. We also know that from our consumer sentiment survey that most consumers are still not particularly keen on real estate as an investment option. And again, that tells us that we're not likely to see investors really pile in, which means the supply side is going to be pretty constrained for the foreseeable future. When we think about the construction of new dwellings as well, that side of things is going to be quite a slow increase. In fact, it doesn't look like we'll see a near-term increase, even though the government's released a very ambitious housing accord target of 1.2 million dwellings over the 5 years to 2029. Those dwellings are going to be very hard to buy. That's a very large and very ambitious new supply. It's going to be hard to meet those targets without having a high density proportion to that build. And again, that's going to be a very hard part to get across the line, given the additional constraints around rising construction costs and so on. So I think the long story short here is that supply is not going to ride to the rescue for rental markets. What may happen instead is, as rents continue to push high, we may see demand start to weaken, and by which I mean new household formation. People will be less inclined to move out of their existing family homes in particular to form those new rental households. They may start to look more interstate or at different regions to form a household, and that'll take some of the edge off, although to some extent that's a game of musical chairs. It just takes the pressures from one part of the market to another. So long story short, there doesn't look to be any real end in sight to this rental problem, and there's some really deep-seated supply issues that are going to prevent things from rebalancing.